We hear a lot of discussion today about indexes. What would a client need to understand before going into an index or using one?
I am worried about the little education most investors have when it comes to indexing. Indexes are not necessarily as transparent as one would believe. We believe there's a way you can utilize indexing to help upside capture results, but in order to leverage that, you also want to integrate or at least be educated on other indexing or a managed approach that will help manage the downside capture risk. And if you weave the two together, long term you can get a great portfolio. The challenge of indexing is because indexing typically aren't managed, okay? The quality can become an issue. First of all, quality impacts results, okay? So when you have a portfolio that has poor quality stocks, ultimately that quality is going to impact the results. If you go back over the last 10 or 15 years, index funds, if you just take the S&P 500, has had a series of delistings each year. These are companies that are actually delisted from the index, and for a lot of reasons because of quality. So again, I want to make sure I'm clear on this. Indexing is not a bad thing. We actually believe in indexing. We actually apply more factor-based indexing, which is a subject in itself that focuses more on quality. Over the years, I've built a whole team that's focused more on building an efficient portfolio based on efficiencies and avoiding the things that don't work. As long as you focus on the client's result, in my mind, you always win.